All right. Good evening. I welcome all of you to SIAS First REIT virtual dialogue session. First REIT, Singapore's first healthcare REIT, has grown since its listing in 2006 to include a portfolio of 20 healthcare properties in Indonesia, Singapore, and South Korea. First REIT is managed by First REIT Management, which is jointly owned by OUE Limited and OUE Lippo Healthcare Limited, and is entitled to the right of first refusal to the pipeline of hospitals in Indonesia by Lippo Karawaci, the largest broad-based listed property company in Indonesia. Beyond this entitlement, Lippo Karawaci contributes significantly to First REIT's revenue. Around 72% of its rental income comes from the master lease agreements, MLAs, between both parties, which covers 11 hospitals in Indonesia. COVID-19 being a health crisis, First REIT is not spared from the direct and indirect ramifications of this pandemic. The confluence of Lippo Karawaci's beleaguered financial status, in view of the significant changes to Indonesia's economic and operating environment and near-term refinancing pressure, necessitated First REIT to propose a restructuring of the existing MLAs with Lippo Karawaci, as well as a recapitalizing First REIT through a rights issuance. No doubt unit holders would be keenly interested and understandably have plenty of questions pertaining to the proposed corporate actions from First REIT. I have presided over a numerous number of dialogue sessions on our platform. Today's dialogue session is not an easy one, and unit holders would expect answers to their questions. So I'm pleased to have First REIT's board and management with me on the panel this evening to provide updates and additional information on the proposed set of corporate actions and to answer questions plainly already posed by unit holders. This exercise, as I said, is not an easy one to comprehend. Hence, this dialogue session is organized by SIAS with First REIT First REIT for you to understand the corporate actions and to make an informed decision. I now introduce the board members, Mr. Adrian Chan, Chairman, Independent Committee, Mr. Victor Tan, Executive Director and CEO of First REIT, Mr. Martin Legner, Independent Director. Thank you, gentlemen, for coming today. I appreciate your presence. I now invite the Chairman of the Independent Committee, Mr. Adrian Chan, to address you, followed by the CEO, Mr. Victor Chan, to explain the proposed set of corporate actions to be tabled in the upcoming EGM. Over to you, Adrian.
Thank you very much, David. Very good afternoon or good evening to everyone spending time with us to learn more about our proposals for First REIT. Like David said, First REIT was listed about 14 years ago. I myself joined the board over 2 years ago. And over the years, First REIT has generated stable dividends and returns for unit holders. But now we are facing, about 3 challenges that threaten our future. And I understand that unit holders are concerned, have many questions, and I hope this no-hold-bar session will answer most of them. But these challenges are these. First, like David mentioned also, Lippo Karawaci, or we'll call it LK, who is our master lessee, accounts for about 72% and above of our rental income. LK is facing significant financial stress. And we have assessed that there is a real and high risk that if we don't do anything, they will default under their current master lease agreements with us. And if they do default and are unable to pay the rent under the MLA's master lease agreements, there will be serious consequences for all of us at First REIT. Secondly, we have a refinancing of $196.6 million of debt due on 1st March, little under 2 months away. This debt represents about 40% of our total debt, and our lenders have concerns over the sustainability of our capital structure because of the issues that LK faces. So the issues that LK face actually has severe impact and consequences on our ability to refinance our debt. Thirdly, the expiry of a few master lease agreements at the end of this year, which collectively represent about 25% of our portfolio by valuation, has been a sort of overhang over First REIT, which we have been working hard to resolve over the last few years. So discussions about the renewals of these master lease agreements that are expiring have been a topic of discussion, but now given the financial stress of LK, we realize that they are not able to renew those on the same terms. So with all these three factors, we've been working hard to come up with a plan that will allow us to restructure, recapitalize, and reposition First REIT to take advantage of the growth potential in the sector. Now, this plan involves restructuring the existing MLAs, the existing master lease agreements for the hospitals that have been leased to LK to ensure long-term viability and long-term sustainability. This will actually ground valuations and cash flows to give certainty to unit holders that our assets, and will basically provide a critical path for recapitalization. And then the recapitalization plan comprises both a $158 million rights issue, which Victor will go into details of, and new bank facilities of about $260 million, which we already announced on Christmas Eve. This recapitalization plan is critical for us to avoid defaulting on the $96 million in debt that's due on 1st March. Now, the board has taken serious steps to explore all options, and Victor will go into detail. We looked at various financing options, and we have concluded that the rights issue is the best option available to us. And we formed the independent board committee, which I chair as lead independent director. We've had Bank of America Merrill Lynch as financial advisor to help us with the restructuring. And we've luckily obtained the support of OUE, our sponsor, and its concert parties, including OUE Lippo Healthcare. And they have provided irrevocable undertakings to backstop the entire rights issue. But to wind back, in order to execute the rights issue, we need to actually make sure that valuations and cash flows of our assets are certain so that we can make informed decisions. And this is only possible if we first undertake the master lease agreement restructuring. So we need unit holders to approve the restructuring, stabilize First REIT, and then we can embark on the rights issue to recapitalize and ensure that we have a sustainable business and stable capital structure to position us for the future. And to give you more details of these proposals, I would like to pass the mic to Victor Tan, our CEO, who will give you a few slides, I believe. Victor, over to you.
Thank you so much, Adrian. Hi, good evening, everyone. To our unit holder, thank you for taking time to listen to us on our plan to restructure, recapitalize, and also reposition First REIT. Can I turn your attention to slide 3 of the presentation back?
Yes.
Okay, what are the proposed transactions that I'm going to share today? We set out the two key elements of the upcoming transaction. The first key element relates to the restructuring of LK Master Lease Agreement. Detail of this proposed restructuring was first announced on 29 November to restructure the leases relating to 11 hospitals in Indonesia, which are currently leased to either LK or certain subsidiary of Siloam. Siloam being the hospital operator for all our hospitals in Indonesia. A similar restructuring was also being carried out for 3 other hospitals currently leased to a third-party tenant, PTMPU. And this was also announced on 29 November 2020. The second key element relates to the recapitalization of First REIT. We intend to undertake a right issue to raise gross proceeds of approximately 158 million on a renounceable basis to all unit holders on a pro rata basis of 98 right unit for every 100 existing unit held. The right issue price is at an indicative price of 20 cents per right unit. The proposed right issue is critical for First REIT. The right issue is proposed because First REIT currently faces a significant refinancing wall. Approximately 80% of its debt, or around 396 million, is coming due within the next 18 months. With the gross proceeds raised from the proposed right issue, and together with the new facility agreement, which we have entered into with OCBC and CIMB Bank, for loan facility of up to 260 million, as we announced on Christmas Eve Day last year, this will allow First REIT to refinance its existing 400 million secured loan facility, which include 196 million repayment, which is due on 1st of March 2021. And as a show of commitment, our sponsor group, OUE Limited, has provided an irrevocable undertaking to backstop the entire proposed right issue, and this will be elaborated on later. While we have explored many other funding options, including trying to divest our asset, but at this juncture, and taking into account the time constraints, we are of the view that the proposed right issue is critical for First REIT, and this is the only viable option which will give First REIT funding certainty to avoid a default of the 196 million repayment obligation that is due in less than 2 months' time on the 1st of March 2021. Just to give you a little bit of background and context to this proposed transaction, the manager understands that LK is facing severe liquidity pressure due to its significant recurring expenses, its weak operating cash flow, as well as its inability to divest assets. Since 2015, LK has been generating negative operating cash flow, and with an aggregate negative cash flow of approximately 1.5 billion Sing dollar. The situation is further aggravated by the depreciation of Indonesian rupiah against the Sing dollar by more than 45% since IPO. And this added further pressure to them because the rental payment under the existing leases are all paid in Sing dollar. And this is further worsened by the impact of COVID-19 pandemic on LK businesses, which has further weakened its operating performance in the medium term. And this is the reason why we have to carry out this proposed restructuring, because we understand that without the restructuring, there is a high chance that LK would default under the existing lease arrangement. LK dire liquidity position has also been confirmed by rating agency in their most recent credit rating report. And some of the potential consequences of a LK default under the existing leases are, we could potentially lose approximately 72% of rental income. And we will be in breach of some of the existing loan or debt covenant. And then this would impair our ability to execute any refinancing plan and to meet its existing repayment obligation. As a result, we will be engaged in lengthy, costly, and cumbersome legal dispute, while in the meantime, we will continue to incur operating expenses, potential capex on our hospital asset, and we will have to trigger a very difficult, uncertain, as well as lengthy leasing exercise in a bid to secure an alternative tenant and operator. As mentioned earlier, First REIT faced a refinancing wall of approximately 396 million. Around 80% of our existing debt are due within the next 18 months. And out of this 80%, 40% is coming due on 1st March 2021. The other issue that First REIT is facing is the impending expiry of our IPO leases, which account for 24% of First REIT gross floor area. And these IPO leases are expiring and are due for renewal in December 2021. Our lender has expressed significant concern over the sustainability of First REIT capital structure in the light of the financial circumstances that surrounding LK, as well as LK intention to restructure all its leases. And our unit holder, as well as other stakeholders, rely on First REIT valuation as well as the visibility on our future cash flow in order to make decisions regarding First REIT. And if we are unable to complete the proposed restructuring, First REIT will not be able to proceed with the proposed right issue, which is urgently needed. We understand that without the proposed restructuring, there is a real risk and high probability that LK would default under the existing arrangement. Hence, the proposed restructuring should be carried out due to the following reason. We avoid the adverse consequence of a default by LK under the existing leases and the resulting termination of the existing lease. Should LK default, this will result in an immediate loss of approximately 72% of First REIT rental income, and it will cause breaches to First REIT debt covenant, and it will impair First REIT ability to execute any refinancing plan and meet its rent repayment obligation, in particular, the 196 million debt that's coming due in March this year. And we avoid the time, the cost, and the complication of enforcing legal right in Indonesia, which we will have to deal with should LK default under the existing leases. And should there be a legal dispute, First REIT will be embroiled in a lengthy, expensive process of enforcing its legal right, as well as to obtain vacant possession of the relevant hospital in Indonesia. And during this period of dispute and legal proceeding, First REIT would not be receiving any income from the hospital, but at the same time still be required to fund any costly legal proceeding against LK, as well as to pay the interest payment to the bank and also other operating expenses. And this will provide clarity on asset valuation as well as cash flow. And when we do the restructuring, we will extend the term of all the LK leases to 31st of December 2035. Thus, this will help to achieve certainty in cash flow and valuation of First REIT going forward. And this certainty in income stream and valuation of First REIT till 2035 will facilitate debt refinancing for First REIT, both in the short term as well as in the coming year. Another reason is that we also want to take into account the changed economic environment in Indonesia, given the state of the Indonesian economy and the COVID-19 pandemic that's hitting them very hard. And this has a significant adverse impact on the revenue generated by the hospital operation as well as their patient volume. And this will provide a sustainable as well as stable long-term master lease structure with regular fixed increment and potential additional upside through the performance-based rent mechanism, which I will elaborate later. And lastly, we want to preserve the long-term value of first REIT unit holder by maintaining the current ecosystem of having LK and Siloam as the operator of LK Hospital. I also like to highlight that the proposed LK restructuring is the best option that we have, following very intensive and extensive negotiation with our stakeholder, and it paves a sustainable path for First REIT going forward and to avoid the adverse consequence of a default by LK under the existing lease. This will reposition First REIT for future growth and preserve long-term value for unit holder. And additionally, as covered earlier, through this proposed transaction, we will resolve an imminent default of repayment obligation due on 1st of March 2021 and facilitate having in place a sustainable capital structure. Let me go into the term of the proposed LK MLA restructuring. Under the proposed LK MLA restructuring, as well as that of MPU restructuring, the term of all the leases will be extended to 31st December 2035, with an option for a further 15-year term by mutual agreement. The renter under all the restructure term will be the higher of either the base rent or the performance-based rent. And the total base rent shall be payable in Indonesian rupiah instead of Sing dollar. And the term will start from 1st January 2021. The amount will be approximately 50.9 million Sing dollar, or approximately 550.7 billion rupiah per annum. The commencement rent, base rent, will enjoy a fixed annual escalation of 4.5% compared to the existing base rent escalation, which is capped at only 2% per annum. The higher escalation rate is intended to compensate for the increased volatility associated with the proposed switch in the rental payment currency from Sing dollar to Indonesian rupiah. The restructuring will also feature a new performance-based rent formula, where the actual rent pay will be the higher of either base rent, which is increasing at 4.5% per annum, or the performance-based rent, which is at 8% of the relevant hospital gross operating revenue for the preceding year. Okay, this new performance-based rent replaces the existing variable rent structure, which has contributed not more than 4.2% to the total rent for each year over the past 3 years under the existing term. And this new formula will provide an enhanced upside sharing mechanism for us. In terms of security deposit, under the restructure term, it will be increased from 6 months to 8 months. And for those assets that are not under the proposed restructuring, the rental term, be it the base rent, the variable rent structure, and the rental payment currency will remain unchanged. As mentioned earlier, under the term of the proposed restructuring, the higher escalation rate is intended to compensate for the potential increased volatility associated with the proposed switch in the rental payment currency from Sing dollar to Indonesian rupiah. And moving forward, the base rent will be based on a new formula of either the highest of the base rent plus 4.5% annual escalation, or 8% of the hospital gross operating revenue of the preceding year. Next slide. This slide provides further detail on the effect of the upside sharing mechanism that has been built into the proposed LK MLA restructuring. As explained earlier, the proposed restructuring features a new performance-based rent formula, where the actual rent received will be the highest of either base rent, which is increasing at 4.5% per annum, or the performance-based rent, which is at 8% of the relevant hospital gross operating revenue for the preceding year. And this will replace the existing variable rent structure, which has contributed not more than 4.2% to the total rent for each year over the past 3 years under the existing structure. Thus, this new formula will provide added upside sharing mechanism for First REIT. This slide merely highlights more clearly the weighted average lease expiry or WALE for First REIT will be extended from 7.4 years to 12.6 years post restructuring. And this will provide more certain and stable lease profile to reposition First REIT for future growth. So what is the use of the proceeds for the proposed right issue? On the proposed right issue, we are expected to raise gross proceeds of approximately 158 million. And the gross proceeds raised from the right issue are intended to be used as follows. 140 million will be used to repay part of the secured loan facility, of which 196 million is due on 1st March 2021. Payment of 5.5 million for the estimated professional and other fees to be incurred by First REIT in connection with the right issue. Payment of 3.4 million for the cost of master lease restructuring. And the balance of 9.3 million will be for working capital of First REIT. We are grateful to our sponsor, OUE Group, for supporting us through this right issue exercise. They are providing irrevocable undertaking for us to subscribe to all the right issue on a pro rata entitlement, as well as to subscribe to any excess right to the extent that is not taken up by the other unit holder. In the next 2 slides, I will take you through the pro forma financial effect of this proposed transaction. Can I have the next slide, please? Yeah. The rental income after the proposed restructuring, as well as the right issue, will drop from 115.3 million to 77.6 million. Our NAV will drop from 99.6 cents to 36 cents after taking into consideration the proposed transaction. Our leverage ratio, gearing, will be at 34% post restructuring. If you look at our DPU yield, based on an indicative right issue price of 20 cents, it is about 13%. And our DPU yield, based on the theoretical ex-right price, is 8.5%. Based on our current debt maturity profile, in 2021, about 40% of our debt maturity profile will be up for refinancing. Another 40% is up for refinancing in 2022, and the balance of 20% is for refinancing in 2023. But with the proposed transaction, we'll be using the proceeds from the right issue to par down 140 million, which is the difference between the 400 million secured loan facility and the 260 million refinancing facility that we managed to obtain from OCBC and CIMB as we announced on 24th of December 2020. Hence, in the new debt maturity profile, there will be no refinancing for the year 2021. The next refinancing period will be 2022, where 28% of our total debt will be up for refinancing then, and the remaining 72% debt will only be refinanced in 2023. Unitholder fund will improve from 412 million to 571 million if the proposed transaction are executed. Our total capitalization will be 978 million, and our leverage ratio will go down from 48% to 34% post right issue. Okay, so at this coming EGM, we will be tabling the following resolution for approval. Resolution 1 will be required to effect the proposed LK-MLA restructuring. And Resolution 2 is required for the waiver from unitholder of their rights to receive a general offer from our sponsor group. This is also known as the proposed whitewash resolution. Maybe let me just elaborate a little bit more on Resolution 2. Based on the latest unit holding statistic, CDPL, which is 100% subsidiary of OUE Limited, and its concert party has a total of about 159.2 million units, which is about 19.73% stake in First REIT. And assuming that unit holder other than First REIT manager and OUE Lipo Healthcare do not take out their pro rata entitlement and to accept and apply for the access right, CDPL and its concert party are expected to have a total interest in approximately 950.3 million units. And this represents approximately about 59.5% of the total stake in First REIT post completion of right issue. As CDPL and its concert party currently hold less than 30%, so under the takeover code rule, if CDPL and its concert party acquire 30% or more in First REIT, they would be obliged to make a mandatory offer. Hence, this Resolution 2 is required for the waiver from unitholder of their right to receive a general offer from our sponsor group. Unitholder should note a few key matters. Number one, the voting threshold is more than 50% for each resolution to be passed. And number two, unitholders should note that Resolution 1 and Resolution 2 are not interconditional upon each other. However, the manager will not launch the right issue unless Resolution 1 is passed. And in the event that Resolution 2 is not passed, we will not launch the right issue unless we are able to arrange for the right issue to be underwritten. It should be noted that the OUE Group irrevocable undertaking are conditional upon the passing of Resolution 1 and Resolution 2. IFA recommendation. Based on the opinion of the IFA, the proposed restructuring is based on normal commercial terms and would not be prejudicial to the interest of First REIT or its minority unitholder. Further, the IFA also opined that the term of the right issue and the proposed whitewash resolution are fair and reasonable. And accordingly, the independent committee and the audit and risk committee recommend unitholder to vote in favor of Resolution 1 and Resolution 2 at the upcoming EGM. This slide shows the recommendation by the independent committee and the audit and risk committee to the unitholder, which I already shared earlier. Okay, due to the COVID-19 situation, our EGM will be conducted via electronic means. This slide outlines the proxy form and provide guidance to our unitholder on how they can cast their vote at the upcoming EGM. Here are the important dates for unitholder to note. Last day for pre-registration for EGM and to submit the proxy form is 16th of January 2021 by 2:30 p.m. And the date and time of our EGM is 2:30 p.m. on 19th of January 2021, which is a Tuesday. So what is the outlook for the restructure, recapitalize, reposition First REIT? We remain very optimistic about the future of First REIT. The proposed transaction will provide 5 key positives for First REIT. Number one, we have entered into a new sustainable 15-year leases with our key tenant. Number two, we have locked in enhanced escalation and upside sharing mechanism. And number three, our sponsor-backed recapitalization will reset our capital structure to a more sustainable level going forward. And number four, the recapitalized REIT will enjoy higher debt headroom to continue to grow and diversify from LiPo, and this will be supported by our sponsor pipeline. And lastly, the restructuring will ensure the continued future of First REIT and allow our unitholder to continue to enjoy exposure in the attractive healthcare sector. This set of positive will create a highly attractive investment TC for the restructure, recapitalize, and reposition First REIT. On a pro forma basis, our DPU yield is between 11 to 13%, which represent a very healthy spread of 5.2 to 7.1% over the Indonesia risk-free rate. And this is close to double that of our competitor. The base DPU yield is highly defensive as it is supported by a sustainable lease structure with a WALE of over 12.6 years, which is significantly longer than our peer. And this will provide a very defensive set of long-term base cash flow to support our base DPU yield. Further, from a total return perspective, 73% of our portfolio will have a minimum rental escalation of 4.5%, and there are further upside from our performance rental structure. And this will provide lock-in organic growth, which will support our total return story. Beyond the rental growth, the recapitalization will also reset our capital structure, and we will have a very healthy gearing of 34% with zero refinancing obligation over the next 16 months. And this will provide a path for further funding source diversification as well as optimization. On top of our organic growth path, we will now have a debt headroom of up to about 320 million to support any M&A activity. And this is complemented by our sponsor healthcare network in developed countries such as Japan and growth markets such as China and Myanmar. So at the end of this exercise, First REIT will enter into a new phase, and we believe that First REIT 2.0 will be well positioned to execute our state objective of diversifying our tenant base and expand into countries with positive market fundamental, and to continue to offer our unit holder exposure to the highly attractive healthcare market. So this new sustainable 15 new MLA will transform our cash flow profile. Under our previous structure, the MLA, as we understand from our master lessee, were unsustainable, and there is a high risk of default. Plus, we face a large lease renewal wall with over 38% expiring in the next 5 years. So follow the restructuring, our cash flow will be backed by a sustainable lease structure with commencement base rent of approximately 40 to 45% of the hospital EBITDA. Further, the new 15-year lease increased our WALE to over 12.6 years, with only 10% expiring over the next 5 years. And this will provide a highly visible stream of locked-in cash flow to support our base DPU and yield. So following the restructuring, over 73% of our income base will enjoy a minimum 4.5% escalation. And this will increase our base rent by approximately 60% in 10 years' time. Based on beyond the base escalation, our upside sharing also improved under the new performance base rent structure. Looking at the chart on the bottom right, you can see that our new performance base rent will result in a higher performance base rent going forward. More importantly, this new upside sharing formula is also more permanent, as it is an applied percentage on the hospital gross operating revenue as opposed to the current structure. Under the current structure, in order for performance rent to kick in, the hospital need to achieve a minimum gross operating revenue growth of more than 5% every year. Our sponsor has been very supportive of us and very instrumental in our two-pronged 418 million recapitalization plan. On the equity fund, the sponsor is committing up to 150 million of fresh equity infusion into First REIT. This is done via the backstop of the right issue. On the debt side, the sponsor has been working with us in our engagement and discussion with all lenders. As this was actually announced on Christmas Eve Day, as we managed to secure the 260 million new refinancing facility. And this recapitalization will reset our capital structure to a more sustainable basis. Our gearing will be a healthy level at 34%, and our weighted average term of maturity for the debt will be extended to 1.94 years, with no refinancing due in the next 16 months. Thus, this will provide a path for further funding, source diversification, and optimization. The reset capital structure will provide us with significant firepower for M&A-driven growth. Following the recapitalization, our debt headroom will be up to 320 million. And our firepower is complemented by our unique access to our sponsor healthcare network across developed countries such as Japan, growth market as in China, Myanmar, and we are not just confined to our sponsor highlight. We can also look at other focus markets like Europe, UK, and even Australia. And this will provide us with a strong platform to execute our state objective to diversify from Indonesia and LiPo-related tenancy and further transform First REIT. We remain very, very optimistic about this healthcare sector. We are in the right sector. Okay. The long-term outlook for the healthcare sector remains very robust and very strong. It is expected to grow at a compound growth rate of 5.5% over the next few years and beyond. There are also expected to be strong growth in key global markets across China, Japan, Europe, largely driven by rapid aging population as well as affluent society. Even Indonesia healthcare market is also well positioned to benefit from technology development as well as improvement in healthcare infrastructure. More so as they are still coming from a very, very low base. Overall, we remain very optimistic and very bullish in this healthcare sector that we are in. I just want to end my presentation today and would like to thank the following key transaction party as listed here. Our immediate priority is to focus on stabilizing First REIT. The proposed restructuring will result in a very sustainable and stable long-term master lease structure. And it is expected to set a clear path ahead for us to recapitalize itself and to establish a long-term return with potential upside sharing for our unit holder. Our objective remains focused on growing unit holder value, but we need your support to vote and approve the resolution that will allow First REIT to emerge from its current challenge, restructure, recapitalize, and reposition for the future. Thank you so much. Yeah.
Thank you. Thank you, Victor, for your presentation. We have received, now it's Q&A time, we have received many good questions from the unit holders, and we wish to cover all the questions, but in the interest of time, we have grouped the questions, and and we will show you on the screen what the questions are we have grouped. Can you show the questions that we received slowly. Okay, so first question, go down slowly. These are the questions that were received. Slowly. Okay, next. So why don't you go after LPKR and enforce the current plan? Also, how can we be sure LPKR will honor the restructured plan? If they have unilaterally walked away from the obligation once, the unit holders, some of them say, they can also do it again. How are you protecting unit holder interests? Over to you, Victor.
David, maybe I can
Okay,
take
Adrian.
this.
Okay.
Adrian, yeah.
Yes.
So it's a great question. So thank you for that. So let me start by saying that we explored with our lawyers, Alan and Glehill, the possibility of enforcing the current master lease agreements. We have binding agreements with LK, and we had earlier expected them to honor them. But because of their deteriorating financial position, and based on legal advice on the difficulties in enforcing the master lease agreements in Indonesia, we've discovered that if LK actually goes into complete financial distress and fails to pay us, goes into default, and creditors swarm over LK, it'll be like sharks in the sea with blood, So getting into the waters to look for some recovery is going to be not only lengthy and costly, but there's a lot of uncertainty about the arbitration process in Indonesia as well. So at the end of that, if we do decide to roll up our sleeves and actually conduct legal proceedings in Indonesia, we have to remind ourselves that we are still not being able to recover and get rental income during that long period, and actually unwinding ourselves from the leases, finding a replacement lessee to operate the hospitals. These are all huge challenges to us. And then we looked at what alternatives we could have instead of enforcement. And we believe that the root cause is we need to restructure so that the master lease agreements are sustainable and viable, both for us as First REIT, but also as for LK as the master lessee and Siloam as the hospital operator. So there are many stakeholders in this, and we believe after looking at the credit standing of Siloam, how they're doing, LK, the future of LK, its financials, and the people behind both LK and Siloam, with this restructured proposal of the master leases, we believe that it's not just sustainable for us, but it's more sustainable for LK as well. And the chances of them defaulting is much less. So we believe that this entire exercise mitigates the risk of having to enforce the master leases in the future.
So you're saying they will honor the restructured plan?
Yeah. We believe that they will honor it, and this, after long negotiations, we believe that it's in their best interest to honor it. And we believe that LK starts off from a good faith basis when they broached it with us, and it was long and tough, the negotiations with LK. But I believe at the end of the day, we have something that both sides can live with much longer and will enable LK to thrive in Indonesia and First REIT to thrive in Singapore.
Okay, so the unit holders' interests will be protected by the fact that the restructured plan will be honored and they will not walk away, and that they will see value in this.
Yes.
Okay. Now, is there a bigger problem than just COVID-19 induced revenue decline in the hospital? Is there a big problem?
Yeah, here I'll jump in and then I'll let Victor
Yes.
elaborate on this. But COVID-19 isn't the sole problem. I think if you look at how LK has been performing, they've faced financial distress even before COVID, and COVID was it definitely didn't help, you know. So it is another nail in the coffin if we don't act fast for LK. Victor, you want to elaborate on that point?
Yeah,
On
I think on
LK's
this
financials?
front, yeah, I think I shared in my slide early on is that LK is actually having negative operating cash flow since 2015.
Due to?
Up to a tune of about 1.5 billion Sing dollar, due to the fact that the property market is you know, is in Indonesia is really going through a slump, you know, hence they are facing severe liquidity pressure due to significant recurring expenses, weak operating cash flow, as well as inability to divest most of its assets.
Right.
And of course, the situation is compounded by the fact that they have to pay us Sing dollar rental, and consider the fact that Indonesian rupiah has been depreciating against Sing dollar by approximately 45% since IPO. And of course, the COVID-19 pandemic is not helpful to them at all. It kind of like further weaken their operating performance in the near to midterm, and it set them back by another couple of quarters or years.
Okay.
Yeah.
All right. Thank you for that. Now, based on the revised base rent amount for Indonesia, that is 56.7 million Singapore dollars, how many percent of the gross operating revenue does this represent on a pro forma basis for financial year 2019 and first half of 2020?
Okay, this revised base rent will be in the range of about 40 to 45% of the hospital EBITDA.
Right.
So this is actually very in line with the percentage range of other healthcare REIT in ASEAN as well as North America, as observed by our valuer, Cushman and Wakefield. If you look at some of our competitors, like for instance, Parkway, Life REIT, Northwest Healthcare Property, Medical Property Trust, and even Religare Health Trust. Their base rent is actually in the range of between 40 to 50 of the hospital EBITDA. So this new revised base rent amount is very, very in line with the market, which means that this will be very sustainable going forward.
Okay, let's assume that unit holder approval is at the AGM is not obtained. Let's assume for a moment. What is your plan B?
David Martin here.
Yes, Martin. Thank you for coming in.
You're welcome. As outlined earlier with the 3 challenges we were facing, we had to act, and restructuring and recapitalization is the only possible way. So unfortunately, there is no plan B. We believe that the restructuring and then recapitalization is the right way to do it, and it gives the company the refinancing flexibility which we need. We have to refinance 196.6 million, and we have an additional 260 million from the 400 million we have now, so there's a gap of 140 million, and we have to come up with this gap. So therefore, next to the restructuring of the master lease, we have to do the recapitalization. And unfortunately, we need the support of the shareholders for those 2 votes.
Martin, I understand you come from a family office in Germany.
That's correct. I manage a
Yeah,
multi-family office
it's a big family office.
Switzerland. It's quite big
So
in
you are
size.
used to,
A
yes,
couple
so
of
you are used to investing, right?
I invest since exactly 24 years,
Yes.
and do that across liquid assets and illiquid assets. So from stocks, bonds to real estate, everything all across the world.
So tell me, if this is true, how confident are you that all what has been said will happen?
First of all, we had intense discussions with Lippo Caravaci, the new management of Lippo Caravaci, the new external shareholders of Lippo Caravaci, which both I had a very professional impression. So I think that Lippo Caravaci is on a good path. And with this restructuring, I have no doubt they will fulfill their 15-year obligation they have with us. We talked to Siloam. Siloam is a very professional, the best possible operator we can get for our hospitals. CVC, a big global private equity group, bought a 26% stake in Siloam. They help to professionalize, to internationalize management. And I think with Siloam, we have very professional operator of our hospitals. And then come to the terms of the transaction. And please, let me express and emphasize again, I'm very well aware of the negative share price development in 2020 and the financially painful experience for our existing shareholders. But from the current share price level, plus the 20 cents rights issue price, I think the terms speak for themselves. It's at a price book value of 0.65 after the reduced and very realistic book values we got from Cushman & Wakefield and Knight Franks as our evaluators. The gearing due to the refinancing from our banks is 35%, gives us a lot of headroom, is conservative, puts us in a strong financial situation. The dividend yield of 13%, yes, it's partly due to the Indonesian rupee, but it's way above what the market rate. 15-year master lease, base rent escalation of 4.5%, again compensates us very well for any inflation, which is currently in the 2 to 3% range in Indonesia, so much lower. So I think it's a good package, and as a shareholder, I think it's financially interesting.
You're full of confidence, Martin. Thank you. Why don't you consider asset divestment or liquidating the REIT, ask some unit holders? Isn't this better than dilutive rights issue, they ask?
Maybe let me answer this.
Yes.
Yeah, we actually have explored other funding options. Of course, we look at asset divestment as well. More so, we do have some non-core asset in our portfolio. Like, for instance, we do have a hotel,
yes,
a country club, and then we also have more that is linked to our hospital. You know, but I think the practicality, difficulty in conducting a sale process in the midst of current COVID-19 situation, as well as the well-publicized financial difficulty of us, this will not allow us to achieve a very optimal price for our asset.
Yes.
And plus, I mean, if we were to look at selling our hospital, currently we only own the land and the building, and this land and building is actually leased to a third-party operator. So it's also and everybody know that it's leased to LK and Siloam. So it's very challenging for us to even sell the hospital. A new operator will find it very difficult to come in because they would have to take over the existing hospital, which may not be built to suit their unique need. Plus the fact that hospital is a very specialized property, more so Indonesia, and it requires very strict local licensing procedure and regulation. There are a lot of license you need to acquire before you can actually operate the hospital. Of course, with the fact that the ongoing proposed restructuring that we are talking to LK, that will also limit the potential divestment to only our Singapore and South Korea asset. If you look at the value of our Singapore and South Korea asset, you only contribute less than 5% of our total portfolio. As of December 2019, the valuation is only about 40 odd million. And this is actually very low compared to the amount that we need to raise to pay down our loan repayment. Under the loan repayment, there is a condition that we need to raise 140 million to pay down part of the loan in order for the bank to refinance us. So taking into account all these reasons, and we want to preserve unitholder value, hence we feel that right issue is the only viable option for us at this juncture.
All right, so let me go on to question number 6, which contains, we have summarized a few questions from the unit holders. Why such a steep discount on your rights price? Unit holders ask, how was the proposed rights issue price of 20 cents determined? Given that the NAV per share after the rights issue is 0.36 per unit, and unit holders are complaining that this has caused the price to drop further.
Okay, to address this question about the right issue price, actually this is a function of the size of the fund that is required, and also the number of units that First REIT can issue based on the general mandate and the discount to TERP, which is the theoretical ex-right price, based on some market precedent.
Okay.
Okay, the right issue ratio, the issue price, and the discount to TERP, these are all determined after considering the precedent transaction, as well as the amount that we need to raise. And if you look at the issue price of 20 cents, this is only a discount of about 33.3% to the TERP. The TERP is actually 30 cents. So 33.3% discount to TERP is very in line with the recent successful right issue exercise that is in the market. And right issue will be offered on a pro rata basis to all our existing unit holders. So if all unit holders take up the right issue, they will be able to maintain their pro rata unit holding, and they will avoid a dilution. And we have actually made this right issue renounceable. So existing unit holder may accept, or if they do not want to accept the right issue, they can actually renounce it, or they can actually trade it in the market on their new pay right.
All right. So those are the reasons for that. And 7th question is, what is the most critical factor in the lease restructuring deal that affected the lender's confidence? While the hospital leases are renewed and extended in return for the IDR SGD currency peg to be removed, it is not particularly understood by us what the deal breaker during the refinance process is. Please clarify.
Okay, I mean lenders, they require certainty in terms of valuation and cash flow of our asset. And the valuation of the healthcare hospital are premier on the rental term on the existing master lease arrangement. Therefore, when LK came out unilaterally announced their intention to renegotiate the current leases, this has actually given, or rather our lender has expressed a very significant concern over the sustainability of First REIT capital structure going forward. Because, LK hospital make up 72% of our rental income. Hence, we really need to actually come to some form of agreement with LK to restructure the loan to make it a sustainable level going forward, then our valuation and cash flow will be able to be more sustainable, and there will be certainty in our valuation and cash flow going forward. And this will provide comfort to our lenders. David, I think you're on mute.
Okay. Sorry. Did the Audit and Risk Committee of First REIT consider the risk and impact of both the 15-year lease expiry and the maturity of almost $400 million of debt, 80% of debt, all in 2021? Why were these two significant events not spaced further apart so as to not create an issue as currently being faced? Why was this not identified by the auditors, or were they identified? Who will answer this, please?
David, let me please
Yes.
answer.
Thank you.
So the board and the management has been aware that the expiry of the master lease is by end of 21. And we have been in discussions with Lippo Karawaci since 2019. However, then when Lippo Karawaci moved ahead with their announcement in June that they have the intention to restructure, that triggered a sequence of events and consequences for us. And the most important consequence was that our lenders got on our phones and expressed their concerns of our capital structure, and that we had to immediately start working on refinancing, that we can secure as much as possible from the currently 400 million loans, where unfortunately 196 million are due to in March of 21. And as you know, and as we outlined, after intense discussions with our lenders, we were only able to refinance 260 million, and hence we had to go through not only through the restructuring exercise, but also through a recapitalization exercise.
I see. But gentlemen, in August 2020, SGX queried the company on the accuracy of the valuations. The REIT responded with, if I may quote, "The board of directors are of the view that there is no material change to the carrying amounts of First REIT's investment properties for first half 2020 necessary at this stage." May I ask, why did the board make this statement when the first half 2020 distribution income fell 46% and valuations for the affected properties fell by about 35%? So the concern is, how can unit holders trust the information coming from the REIT? Okay, so I'm sure you'll be able to answer this, Adrian.
Yeah, David, this is another very good question.
Right.
So I must say the participants really are putting on their thinking hat. So
Yes.
the background to this is the exchange queried our announcement and in 11th August, right?
Yes. Yes.
And at that time, we explained our rationale and for the assessment that the potential adjustments to the valuations might arise, but because no agreement had been reached with LK then, since their unilateral announcement, the existing master lease agreement terms continue to apply between the parties. Now, if they continue to apply, there was really no basis to actually change the carrying value. And we explained further in our clarification announcements that until parties can agree on new definitive terms, we could not reassess valuations until then. And we subsequently announced the receipt of the non-binding proposal from LK only on 20th September. So more than a month after that, so a much later date. Now, the first half distribution income fell predominantly as a result of the rental reliefs provided to our tenants as a result of the COVID-19 pandemic. Whereas the valuations of the properties drew reference from the LK restructuring terms, which were negotiated by us rigorously. I hope unit holders can understand the complexity of the transaction. It's not just LK, that there is another lessee MPU that we had to negotiate as well. And with the advice of our professionals, we've deliberated at every turn on the negotiations with the intent of achieving the best possible outcome for unit holders.
Okay. Now, investors are concerned, gentlemen, that there are some lines being drawn amongst the family members because of how the assets were separated, such that First REIT does not know that Lippo Karawaci was planning to negotiate the rents down. How are the different parts of the family working together to resolve the issue, they ask? Who will answer this?
Yeah, I'll take this as well, David. So this is a conspiracy theory sort of question, right? And to be fair, it is not an unreasonable question to ask, because there are different parts of the family on both sides, one in Indonesia, one in Singapore. And of course, we cannot speak for LK and their board. They have a separate set of board and management. But what I'd like to say is, I'd like to assure unit holders that we do not believe that there's any issue between the family members of the respective major shareholders. And we've continued to get very, very strong support from our sponsors, OUE. They were not only instrumental in negotiating the refinancing facility for First REIT, but they've also provided irrevocable undertakings to backstop the entire rights issue. And it's because of them that we've managed to get Bank of America, Merrill Lynch as our financial advisor, something that I'm not sure we could have managed to get on our own without OUE support. So with regards to the way different entities operate, while our companies may share some similar shareholders, they all have separate boards and management and different governance standards with respect to Indonesia and Singapore, but we believe that there is no issue between both sides of the family. David, you're on mute again.
Okay, now let me ask, what are the company's plans to improve performance over the long term and to ensure it is more resilient? Now, unit holders need the confidence from you, from this answer from you, gentlemen. Who, Victor or?
Yeah, David, I'll try to attend. Maybe my fellow director, Adrian and Martin, can chip in later on.
Right.
I have been with the company for 12 over years. Okay.
Right.
And before First REIT, I was with Parkway for another 11 years. And of course, Parkway is now under part of the bigger group, IHH. So I have been in this healthcare sector for the past 20 over years. And we still believe that the underlying healthcare sector remain very attractive. Okay. So this proposed recapitalization exercise, together with the proposed LK restructuring, will provide the most optimal option for First REIT to tie through this short-term volatility and to preserve value for unit holder and to position First REIT for future growth.
Right.
We hope that with unit holder support, we will be able to restructure and to recapitalize First REIT. And I already highlighted a couple of key positives as a result of this transaction. We will have high visible contracted cash flow. The new 15-year LK and MPU MLA will extend First REIT will from 7.4 years to 12.6 years, thus providing unit holder a highly visible stream of locked-in cash flow. And with this, certain and stable risk profile, it will reposition us for future growth. And secondly, there will be clarity on our asset valuation, and this will remove any overhang on our unit price caused by existing unsustainable lease structure. And thirdly, we also have embedded and contracted this organic growth. Following this restructuring, 73% of our rental income will have a minimum of 4.5% per annum annual escalation. And at the same time, there will be further upside through a revised performance-based rent structure. And this will provide our unit holder visibility over the minimum income growth of the REIT while retaining exposure for further upside sharing.
Yes. You've talked about taking your healthcare business overseas. Can you talk a bit more about that?
Yeah, that's right. I mean, going forward, we know that the way to go is basically for us to diversify. That's why we will want to diversify into a new market post-restructuring. And on this front, post-restructuring, post-recapitalization, we will have a very healthy gearing limit ratio, which is about 34%, and we will have a very good firepower in the sense that we will have this 320 million of war chest, and coupled with the fact that we will have access to our sponsor OUE group pipeline, nursing home in Japan, hospital in China, in Myanmar, and we are not just confined or restricted to only sponsor pipeline. We can actually look elsewhere. We can actually look at assets in UK, in Europe, and also in Australia and other parts of the world. As long as it's accretive, as long as it makes sense for us to acquire, we definitely can look at it. We can collaborate with our sponsor to go in together.
Yeah. Victor, some of the unit holders are worried about the currency factor, the adverse currency effect that you have had in Indonesia now. So we are going Myanmar and other. Can you tell them how you will overcome this currency difficulty?
Honestly,
Martin,
I know. Yeah.
Martin,
if I could comment on that, David.
Yes.
I think, first of all, in the Indonesian case now, we are with the escalation rate of 4.5% annually, I think very well compensated for the currency risk. In addition to that, the Indonesian rupee had very negative 10 years. And I think there is a potential that going forward, the depreciation will be less. So I'm quite confident and positive about the deal we have on the Indonesian side. No one has the crystal ball.
Yeah.
Financial markets is all about diversification. So the concentration risk became our problem. I think going forward, if we focus on our growth plan on diversification country-wise, and therefore diversification operator-wise and currency-wise, we will get a better mix in our portfolio. Yeah. And that's our goal.
Yeah.
So that's good because different countries have different currencies. But what unit holders would like, Victor, as CEO and the board, is to have updates on your plans. And if you could, tell them today that, updates will be coming, announcements on SGX, and then updates on your website, and Investor Day sort of, communication will assuage the worries of the unit holders. All right. Can that be done? Yeah.
Yeah,
and
sure.
we don't have enough time now, but there are 29 questions more have just come in this evening. What I would propose is we will send to you immediately the questions.
Okay.
Please answer them and put it on your website and on SIAS website. All right, Q&A, so that all the unit holders can read these Q&A questions today asked, the answers given. I believe there's been a recording done today, and that should be made available on your website so that everybody will know the questions and answers given, and the other questions not answered, they must be answered. And I thank all of you, Adrian, Chan, Victor, and Martin Legner for coming forward this evening to face the barrage of questions. And you must continue to instill confidence in the unit holders. It is very at the low ebb, as you know, and I'm confident from today's willingness to come forward and face these difficult questions, you will continue to answer all their questions and assuage them. Thank you very much for coming forward, and I wish you the very best in your corporate actions. All right.
Thank you so much,
David.
David. Thank you. Yeah.
Thank
David,
you.
thank you very
Thank
much.
you, shareholders
Bye.
and investors.
Yeah.